take a careful, sort of methodical approach to make adjustments. Markets can be sensitive to it, and we thought that this was a doubling of the speed. We're basically 2 meetings away now from finishing the taper, and we thought that was the appropriate way to go. So we announced it, and that's what will happen. The question of long and variable lags is an interesting one. That's Milton Friedman's famous statement, and I do think that in this world where where the global financial markets are connected together, financial conditions can change very quickly. And my own sense is that they get into financial conditions affect the economy fairly rapidly, longer than the traditional thought of, a year or 18 months, shorter than that, rather. But in addition, when we communicate about what we're going to do, the markets move immediately to that. So financial conditions are changing to reflect, the forecast that we made, and basically, which was, I think, fairly in line with what markets were expecting. But financial conditions don't wait to change until things actually happen. They change on the expectation of things happening. So I don't think it's a question of having to wait.
Can I just follow up in thinking about having to wait? Is it still the policy or the position of the committee that you will not raise rates until the taper is complete? Thank you.
Yes, the sense of that, of course, being that buying assets is adding accommodation and raising rates is removing accommodation. Since we're 2 meetings away from completing the taper, assuming things go as expected, I think if we wanted to lift off before then you would stop the taper potentially sooner. But it's not something I expect to happen. But I do not think it would be appropriate, and we don't find ourselves in a situation where we might have to raise rates while we're still purchasing assets.
Okay, let's go to Colby at the FT.
Thank you, Michelle. Chair Powell, I'm curious exactly how much distance you think there should be between the end of the taper and the first interest rate increase. Back in 2014, the guidance that was given was for the Fed funds rate to remain at the target level for a considerable time after the end of the asset purchase program. Is that an approach you support now, or does the current economic situation warrant something a bit different? Thank you.
So we haven't made any decision of that nature, and so no, I wouldn't say that's our position at all. We really haven't taken a position on that. I will say that we did talk today. We had our first discussion about the balance sheet, for example, and we went through the sequence of events regarding the runoff and that sort of thing with the balance sheet last time. And I think people thought that was an interesting discussion. They thought that it was informative, but people pointed out that this is a significantly different economic situation that we have at the current time, and that the differences that we see now would tend to influence how we think about the balance sheet. And the same thing would be true about raising rates. I don't foresee that there would be that kind of very extended wait at this time. The economy is so much stronger. I was here at the Fed when we lifted off the last time, and the economy is so much stronger now. It's so much closer to full employment. Inflation is running well above target, and growth is well above potential. There wouldn't be the need for that kind of long delay. Having said that, we'll make this decision in coming meetings, and it's not a decision that the committee has really focused on yet.
Let's go to Nick at the Wall Street Journal.
Thank you. Nick Temeros at the Wall Street Journal. Chair Powell, in March, you answered a question about maximum employment like this. You said 4% would be a nice unemployment rate to get to, but it'll take more than that to get to maximum employment. More recently, you have hinted at a possible distinction between the level of maximum employment that's achievable in the short run versus in the long run. Has your view of the level of maximum employment changed this year, and if so, how? And how close is the economy right now to your judgment of the short run level of maximum employment? Thank you.
Right. So the thing is, we're not going back to the same economy we had in February of 2020. And I think early on, the sense was that's where we were headed. The post-pandemic labor market and the economy in general will be different, and the maximum level of employment that's consistent with price stability evolves over time within a business cycle and over a longer period, in part reflecting evolution of the factors that affect labor supply, including those related to the pandemic. So I would say, look, we're at 4.2% now, and the unemployment rate has been dropping very quickly. So we're already in the vicinity of 4%. The way in which the important metric that has been disappointing really has been labor force participation, of course, where we had widely thought, I had certainly thought that last fall, as unemployment insurance ran off, as vaccinations increased, as schools reopened, that we would see a significant surge, if you will, or at least a surge in labor force participation. So we've begun to see some improvement. We certainly welcome the 0.2 improvement that we got in the November report. But I do think that it feels likely now that the return to higher participation is going to take longer. And in fact, that's been the pattern in past cycles, that labor force participation has tended to recover in the wake of a strong recovery in unemployment, which is what we're getting right now. So it could well have been that this cycle was different because of the short nature of it and the very strong, the number of job openings, for example. You would have thought that would have pulled people back in. But really, it's the pandemic. It's a range of factors. But the reality is we don't have a strong labor force participation recovery yet, and we may not have it for some time. At the same time, we have to make policy now, and inflation is well above target. So this is something we need to take into account.
If I could follow up, you've talked recently about risk management, and so does that mean that the committee might feel compelled to raise interest rates before you're convinced that you've achieved the employment test in your forward guidance?
So this is not at all a decision that the committee has made, but you're really asking a question about how our framework works. And yes, there's a provision, what used to be called the balanced approach provision, that says in effect that in situations in which the pursuit of the maximum employment goal and the price stability goal are not complementary, we have to take account of the distance from the goal and the speed at which we're approaching it. And so that is in effect an off-ramp which could, in concept, be taken, and it's in our framework. It's been in our framework a long time. I've talked about it on a number of occasions. It is a provision that will enable us to, in this case, because of high inflation, move before achieving maximum employment. Now, as I said, we're making rapid progress toward maximum employment in my thinking, in my opinion, and I don't at all know that we'll have to invoke that paragraph. But just as a factual matter, that is part of our framework and has been really for a very long time.
Thank you.
Thanks. We'll go to Howard at Reuters.
Thanks, as usual. So I guess I got to ask about the elephant in the room, which is the Omicron variant. This seems to already be pushing one of your colleagues, the Bank of England, off its course. Things have evolved very fast there. Hasn't quite hit the shores of the U.S. in full force yet, but people seem to expect it to. So I'm wondering, in your feelings about this, are you convinced that this is going to be perhaps a more infectious but less serious variant of the virus, or are you simply confident that the U.S. economy can continue its divorce from the pandemic?
Well, I think there's a lot of uncertainty, which is why we called it out in our statement, our post-meeting statement, as a risk. We follow the same experts, and we talk privately to the same experts that everyone else does, and read the same articles in the paper and the same research. And so you mentioned the early assessment is highly transmissible, perhaps not as severe, some continuing protection from existing vaccines and also existing immunity from having had the disease. That's a first draft. We're a long way from knowing what it will turn out to be. It may well come to the United States and replace Delta as the dominant variant fairly quickly. That could easily happen. I think there's another step there, though, which is what's going to be the effect on the economy, and that will depend, on how much it suppresses demand as opposed to suppressing supply. It is not clear how big the effects would be on either inflation or growth or hiring. On top of what's already going on, which is quite a strong, wave of Delta that's hitting large parts of the country across the northern United States and all the way to the eastern seaboard, and now coming down. We're having quite a wave of Delta. So coming in on top of that, again, it's very difficult to say what the economic effects would be. I do think wave upon wave, people are learning to live with this. More and more people are getting vaccinated. So people who get the new variant, it affects them much less than it tends to affect in the aggregate people who are not vaccinated. So the more people get vaccinated, the less the economic effect. It won't have an economic effect. Delta had an effect of slowing down hiring, and it actually it had an effect on global supply chains, and that sort of that hurt the process of the global supply chains getting worked out. So it can have an economic effect. I just think at this point we don't know much. We'll know a whole lot more in 3 weeks, and we'll know more than that in 6 weeks.
But if I could follow up, you're clearly from a sort of from a risk standpoint comfortable putting away one of your tools pretty soon, which sort of implies that whatever Omicron brings, you're comfortable the economy can handle it without quantitative easing.
Yes. I think if you look at the state of the economy and the strength of demand, the strength of just overall demand, the strength of demand for labor, look at inflation, look at wages. I think moving forward the end of our taper by a few months is really an appropriate thing to do, and I think really Omicron doesn't really have much to do with that.
Thank you.
Let's go to Gina at the New York Times.
Hey, Chair Powell. Thanks for taking our questions. I wonder if you could talk a little bit about what prompted your recent pivot toward greater wariness around inflation. Sure.
So I guess I would go back and, it's been a continual process, really. Inflation really popped up right in the late spring last year. And we had a view, it was very, very widely held in the forecasting community, that this would be temporary. It was quite narrow. A limited number of factors were causing it. And there was a decent amount of evidence to support that view that it would be temporary or transitory, as we said. Certainly, we had 5 months of declining month-on-month monthly readings of inflation, but we didn't see much in the way of progress on labor supply or on other supply side issues. Then in September, I'd say after Labor Day, it started to become clear that this was both larger in its effect on inflation and more persistent. And of course, I said so on many occasions. And one of the consequences of that is that we moved the taper forward. And it's a much faster taper than had been planned. So we've been adapting. I've been saying we're adapting our policy. So come to your real question. We got the ECI reading on the eve of the November meeting. It was the Friday before the November meeting, and it was very high, 5.7% reading for the Employment Compensation Index for the third quarter, not annualized, for the third quarter, just before the meeting. And I thought for a second there whether we should increase our taper. Decided to go ahead with what we had socialized. Then right after that, we got the next Friday after the meeting, 2 days after the meeting, we got a very strong employment report and revisions to prior readings and no increase in labor supply. And the Friday after that, we got the CPI, which was a very high reading. And I honestly, at that point, really decided that I thought we needed to look at speeding up the taper, and we went to work on that. So that's really what happened. It was essentially higher inflation and faster, turns out much faster progress in the labor market. Really what's happening is the unemployment rate is seems to be catching up with a lot of the other readings of a tight labor market, 0.6 over one cycle. So that's really what happened. And, widely supported in the committee today. As you can see, unanimous vote. But beyond that, I think widely supported this move.
If I could just follow up quickly, you noted that the ECI was one of the things that made you nervous, but you also said earlier that you don't see signs that wages are actually factoring into inflation yet. And I guess I wonder how you think about sort of the wage picture as you're making these assessments.
Right. So what I said, you quoted me correctly. It's so far we don't see wages are not a big part of the high inflation story that we're seeing. As you look forward, let's assume that the goods economy does sort itself out and supply chains get working again, and maybe there's a rebalancing back to services and all that kinds of thing. What that leaves behind is the other things that can lead to persistent inflation. In particular, we don't see this yet, but if you had something where real wages were persistently above productivity growth, that puts upward pressure on firms, and they raise prices. It would take something that was persistent and material for that to happen, and we don't see that yet. But with the kind of hot labor market wages we're seeing, it's something that we're watching. And the other thing, of course, is rents, which are very important. Owner's equivalent rent and rent. That's another thing which is very economically sensitive. Unlike the things that are causing the inflation now, this is economically sensitive, and so would be expected to move up. And so as some things go down, the question is, where will we be when we come out the other side of this? And we need to keep our eyes on those things.
Thank you.
Thanks. We'll go to Chris at the AP.
Thank you. Well, next year you could see growth slowing, and you could see some disinflation, particularly if the Omicron variant does spread more widely. Would you delay rate hikes in that situation, and how would you think about that? And also, how would you explain rate hikes if you do follow through in that kind of situation with inflation fading and growth slowing? How would you explain rate hikes to the public, particularly those who may still be looking for work?
Well, as you know, the SEP is not a plan. It's not something we debate, negotiate over, or really discuss in terms of what the right answer should be. People write down their assumptions, their assessment of appropriate policy based on their economic forecast. And so the median, what you're talking about, the 3 rate increases, that's the median of the committee. The median of the committee is also that growth will be 4% and that unemployment will be 3.5% by the end of the year. So that's a really strong economy. And of course, if the economy turns out to be quite different from that, then so will the rate. No one will say, oh, we can't change our policy because we wrote something down in December. That no one's ever said that or will. It will. The actual rate decisions we make will depend on our evolving assessment of the forecast. So, for example, if the economy were to slow down significantly, then you would expect that would have an effect of slowing down rate increases. But we'd have to, we look at our 2 goals, maximum employment and price stability, and we make policy based on them and not with respect to what we wrote down in a prior SEP.
Thank you. Let's go to Victoria Guida at Politico.
Hi, Chair Powell. I wanted to follow up on maximum employment. So, the new framework was basically designed, as I understand it, so that there was a de-emphasis on guessing where inflation would pick up because of employment. And basically, you were going to wait until you saw the whites of the eyes of inflation, and that's how you would kind of know that you reached maximum employment. So I'm wondering, you've talked a lot about the different ways that you might measure maximum employment, but from what I understand, and that's still basically the way that you know that you're there, is inflation. So is that understanding correct? And how are those signals likely to be clear right now, given that you have inflation that's caused by these supply chain disruptions that might also lead to inflation in wages and those sorts of things? So how do you sort of tease out the signal of maximum employment?
Okay, so let me start by saying that the inflation that we got was not at all the inflation we were looking for or talking about in the framework. It really was a completely different thing. It was to do with, strong monetary policy and fiscal stimulus into an economy that was recovering rapidly and in which there were these supply side barriers, which effectively led to, in certain parts of the economy, of what you might call a vertical supply curve. So, automobile purchases are very interest rate sensitive, and you would think demand would drive up the quantity of cars, but it can't because they don't have semiconductors. So that was a very different kind of inflation. This is not the inflation we were looking for under our framework at all. It's nothing to do with our framework, and the way we've approached it is really nothing to do with our framework. But come to maximum employment, which is really your question. How do you know? So I think you look at prices and quantities. If you want to look at maximum employment, you look at prices and quantities, and the main price you look at is wages. It's one of the things you look at, and it's so I mentioned a number of the things. You could get to 20 if you wanted to easily, but labor force participation, the unemployment rate, different age groups of prime age labor force participation in particular gets a lot of focus. The JOLTS data get a lot of focus, and wages. That's really one of the great signals. The quits rate is another one. The quits rate is really one of the very best indicators, according to a lot of labor economists, because people quit because they feel like they can get a better job, and there's record amounts, historically high levels of that going on, suggesting again that you've got a very tight labor market. So on wages, that's the price indicator we look at to tell us, along with all the other data, whether we have labor market conditions that are consistent with maximum employment. And so that's how we think about it. But one of the complications is that, again, we've got to make policy in real time. So how do we think about that? If we think we can make labor, participation might move up. If let's say we knew that it would start to move up in 2 years, would we wait 2 years or when inflation is running way above target? Probably not. So you have to make an assessment that what is the level of maximum employment that is consistent with price stability in real time is one way to think about it.
Just to kind of follow up on that for a second, if you do raise interest rates next year and, you're not certain whether you're at maximum employment, I mean, are you all going to point, when you raise interest rates, are you going to point to ways in which the labor market could still improve?
Yes, I mean, absolutely. I think, whether or not we say we're at labor market conditions consistent with maximum employment next year, we would all be open and I think expect over time that the level of maximum employment that's consistent with price stability would increase further over time. For example, through increasing participation. So we would not in any way want to foreclose the idea that the labor market can get even better. But again, with inflation as high as it is, we have to make policy in real time. We've got to make that assessment in real time.
Thank you. We'll go to Olivia from Bloomberg.
Thank you. Good afternoon, Chair Powell, and thank you for taking our questions. I wanted to follow up on some of your earlier comments about labor force participation. And I wondered, what do you think needs to change in the economy to kind of get a meaningful recovery in labor force participation? And also whether running the economy hot, like in the last expansion, is one way of doing that.
Well, the labor market is, by so many measures, hotter than it ever ran in the last expansion. If you think about it, the ratio of job openings, for example, to vacancies is at all-time highs. Quits, the wages, all those things are even hotter. But what would it take for labor force participation to move up more? That really, why is it low is the question. So there are a bunch of answers, and all of them probably have some validity. Part of it will be that people, for certain people, they don't want to go back in the labor force because either they're medically vulnerable or they're not comfortable going back while COVID is still everywhere. That's one thing. The lack of availability of child care made for caretakers is certainly part of it, not just for children, but for older people. It has been pointed out by many that the stock market is high, people's portfolios are stronger. They may go back to being a one-income rather than a two-income family. The same thing with people's houses. people buy they have a mortgage and with leverage, and the house price increases, the equity they have in their home might have doubled, and they might reach the same conclusion. So and people have savings on their balance sheet because of forced savings, because they couldn't spend on travel and things like that, and also because of government transfers. So for all of those reasons, and it's hard to know exactly the part each of them plays, we have a situation where we've had a shock to labor force participation that is not unwinding as quickly as many has expected. And people, in effect, a good part of it is voluntary. People, and this is how they want to maximize their welfare, and that's certainly their choice. In other cases, it's something that will abate very quickly if and when the pandemic gets under control. And the longer the pandemic goes on, maybe the less likely that people will come back because they get used to their new life and they lose contact with their old jobs. That's what the evidence would say. So it's a range of things. It isn't that the economy lacks stimulus. Usually in every other expansion, it's that there aren't enough jobs and people can't find jobs, and we're stimulating demand and trying to get demand to come up. That's not the problem here. The problem is a supply side problem, which what it would take to work it out, I think it's going to be time. And the number one thing it would really be to have the pandemic get under control. That's what everyone would really like to see. What does the labor market look like in a world without COVID? That would be the thing that we'd really like to see. But it doesn't look like that's coming anytime soon.
And just to quickly follow up on that, if some of the reason that labor force participation isn't back to, February 2020 levels because people are voluntarily making life decisions that are different, does that make you think we're going to end up at a lower rate overall?
Well, there's a demographic trend underlying all of this. And we actually got above the demographic trend at the end of the last expansion. So one would expect over time that labor force participation would move down because an aging population, the older people are, the lower their participation rate is. So you would expect that the trend would be lower and that over time participation would move down. The question of how much we can get back up closer to where we were in February of 2020, and indeed for the year or so before that, is a good one. And I mean, what we can do is try to create the conditions. There's a lot of good for society when you have a tight but stable labor market where people are coming in, they're getting in the labor force, they're getting paid well. In the labor market we had before, we had the biggest wage increases were going to people at the bottom end of the wage spectrum for the last couple of years. There were just a lot of really desirable aspects of a labor market like that. Higher participation is one of them, and we'd love to get back there. But again, ultimately, we have the tools that we have, which are essentially to stimulate demand and also to control inflation. I mean, really, it might be one of the two big threats to getting back to maximum employment is actually high inflation. Because to get back to where we were, the evidence grows that it's going to take some time. And what we need is another long expansion like the ones we've been having over the last 40 years. We've had, I think, 3 of the 4 longest in our recorded history, including the last one, which was the longest in our recorded history. That's what it would really take to get back to the kind of labor market we'd like to see. And to have that happen, we need to make sure that we maintain price stability.
Okay, let's go to Edward Lawrence at Fox.
Thanks, Michelle, and thanks for taking the question, Chair Powell. So I was looking at the census data for estimate monthly changes on sales, and what you're seeing is fewer people spending at restaurants and drinking places, more people spending at grocery stores. You see electronic sales down 4.6% month over month. Also, department store sales down 5.4% month over month. How concerned, or what is your level of concern the consumer may be turning away from this economy or pulling back because of inflation, the virus, or something else? Thank you.
We see consumer expenses very strong in this quarter. I don't know, Edward, whether you're talking about more shopping online versus shopping in the store, but consumer demand is very strong. Incomes are very strong, because people are going back to work and they're getting wage increases. Admittedly, some of the wage increases are being eaten away by inflation, but nonetheless, incomes overall are going up really significantly because of increased employment. and spending has been strong. There may be something in the seasonality that this year's holiday spending may have been pulled forward, and of course there may be effects from Delta, and there might be going forward from Omicron. But fundamentally, though, the consumer is really healthy, and we expect personal consumption expenditures to be pretty strong in the fourth quarter.
Okay, let's go to Mike at Bloomberg.
Mr. Chairman, the median forecast for inflation in this month's or this meeting's economic projections has been revised up significantly for 2021, but barely moved for 2022 and 2023. You've said you expect inflation to fall significantly. Is that because you're going to raise interest rates, or because the virus is going to fade and the effects are going to fade? In other words, is it a question of when, not if, you raise interest rates? And does it suggest that maybe your critics are correct and you might be afraid you're behind the curve?
So actually, I'm looking at the SEP here, and the median forecasts for core and headline inflation did move up by 0.4 each. So that's a significant, in an SEP, that's a pretty significant move up. It's based on both of those things, I suppose. I do think there's a broad expectation among forecasters, including our own, that the bottlenecks will alleviate sometime over the course of this year. If you look at where blue chip forecasts are, which is the group of well-resourced large forecasting operations with a long track record, they'll show inflation coming back down significantly toward the back end of next year. I would say, though, as well, that our policy should begin to have an effect. There will be a lag, but it should begin to have an effect on that as well. That's the most likely case. I guess what the thing I would want to say, though, is we can't act as though that's a certainty, and we're not going to act as though that's a certainty. There's a real risk now, I believe, that inflation may be more persistent, and that may be putting inflation expectations under pressure, and that the risk of higher inflation becoming entrenched has increased. It's certainly increased. I don't think it's high at this moment, but I think it's increased, and I think that's part of the reason behind our move today, is to put ourselves in a position to be able to deal with that risk, and I think we are in a position to deal with that risk. We need to see more data. We need to see how the inflation data and all the data evolve in coming months, but we are prepared to use our tools to make sure that higher inflation doesn't get entrenched. For one reason, as I just mentioned, it's one of the two big threats, the other being the pandemic itself, to getting back to maximum employment.
Let's go to Michael Derby, The Wall Street Journal.
Yeah, thank you for taking my question. So as the Fed shifts towards an accelerated taper, I wonder what your read is on financial stability risks right now. I mean, these periods can be, it seems like the taper process has gone fairly smooth so far, but, what do you see in terms of stability risks? Are there any parts of the financial sector that concern you right now? And are there any significant systemic issues that are on your radar, maybe from the cryptocurrency sector or something like that?
We have had now for a decade and more a four-part financial stability framework that we use so we can hold ourselves to the same kind of framework and not just treat each event individually. And there are four key areas: asset valuations, debt owed by households and businesses, funding risk, and leverage among financial institutions. So I would say asset valuations, I'm going to go really superficially here, but asset valuations are somewhat elevated, I would say. Debt owed by businesses, and households. Households are in very strong financial shape. Businesses actually have a lot of debt, but their default rates are very, very low. But nonetheless, it's something we're watching. Funding risk is by and large low among financial institutions, but we do see money market funds as a vulnerability, and would applaud the SEC's action this week. Leverage among financial institutions is low in the sense that capital is high. So overall, financial stability That's how I would make an overall characteristic, but we break it down into those pieces. In terms of the things that we're looking at, it's the things we've already talked about to some extent. It's the emergence of a new variant that could lead to significant economic. If there were to be a variant, for example, that were quite resistant to vaccines, it could have another significant effect on the economy. We don't see that. We don't have any basis for thinking that the new variant that we have is that one, but it's certainly one we're looking at. I would say, cyber risk, the risk of a successful cyber attack is, for me, always the most, one that we would be very difficult to deal with. I think we know how to deal with bad loans and things like that. I think more a cyber attack that were to take down a major financial institution or financial market utility would be a really significant financial stability risk that we haven't actually faced yet. So I could go on with a list of horribles, but I think that's a decent picture of where I would start.
How about the cryptocurrency issues? Anything that worries you there that's going on in there in terms of, it's obviously a lot's happening in that sector. Is that concern you at all?
I think the concerns there are not so much current financial stability concerns. I, of course, would support the views expressed in the President's Working Group report on stablecoins. Stablecoins can certainly be a useful, efficient, consumer-serving part of the financial system if they're properly regulated, and right now they aren't, and they have the potential to scale, particularly if they were to be associated with one of the very large tech networks that exist, and you could have a payment network that was immediately systemically important, close to immediately systemically important, that didn't have appropriate regulation and protections. The public relies on the government and the Fed in particular to make sure that the payment system is safe and reliable, as well as the dollar, and to provide a safe and reliable, trusted currency. So, but I do think those are longer term. In terms of the more the cryptocurrencies that are really speculative assets, I don't see them as a financial stability concern at the moment. I do think they are risky. They're not backed by anything, and I think there's big consumer issues for consumers who may or may not understand what they're getting, and there's certainly developments in the markets that are worth following, which are really not in our jurisdiction, but things like the kind of leverage that's built into them and those sorts of things is certainly worth watching.
Let's go to Nancy Marshall-Genzer at Marketplace.
Chair Powell. Hi, Chair Powell. Thanks for the question. Going back to inflation, is the Fed behind the curve on getting inflation under control?
So I would say this. I actually think we are well positioned to deal with what's coming, with the range of plausible outcomes that can come. I do, and I think if you look at how we got here, I do think we've been adapting to the incoming data really all the way along, and noticing and calling out that both the effects and the persistence of inflation, of bottlenecks and labor shortages and things like that. So we've been calling out the fact that were becoming longer and more persistent and larger. And now we're in a position where we're ending our taper within the next, by March, in 2 meetings, and we'll be in a position to raise interest rates as and when we think it's appropriate, and we will, to the extent that's appropriate. At the same time, we're going to be seeing a few more months of data. I don't actually think we're out of position now. I think this was an important move for us to make. I think that the data that we got toward the end of the fall was a really strong signal that inflation is more persistent and higher, and that the risk of it remaining higher for longer has grown. And I think we're reacting to that now, and we'll continue to adapt our policy. So I wouldn't look at it that we're behind the curve. I would look at it that we're actually in position now to take the steps that we'll need to take in a thoughtful manner to address all of the issues, including that of too high inflation.
Let's go to Evan at Market News.
Hi, Chair Powell. Thank you. I was wondering if we should still be seeing the taper and interest rate hikes as separate. And secondly, in the last cycle, the Fed started shrinking the balance sheet when short-term interest rates were about 1 to 1.25% range. Do you think the FOMC might be able to potentially start running off assets before that this time?
Are they separate? So our interest rate, yeah, they are separate tools. So the asset purchases are a separate tool from interest rates. Stopping asset purchases does not remove accommodation. It just stops adding further accommodation, whereas raising interest rates starts to remove accommodation from what is a highly accommodative stance. The extent to which they'll be separated in time is something we haven't really discussed at the committee yet. We will be discussing that, obviously, in coming meetings. I don't think the last cycle, there was quite a long separation before interest rates. I don't think that's at all likely in this cycle. We're in a very, very different place with high inflation, strong growth, a really strong economy. That as I mentioned, the SEP medians are for 4% growth next year, 3.5% unemployment at the end of the year, and the headline inflation of 2.6% next year, core at 2.7. So this is a strong economy, one in which it's appropriate for interest rate hikes. So they're separate, I would say. Your second question was?
My second question was about runoff.
Runoff,
in the last cycle.
So with the balance sheet, we did have a balance sheet discussion. It's our sort of first discussion of balance sheet issues at our meeting this week. We'll have another at the next meeting and another after the meeting after that. I suspect these are interesting issues to discuss. Didn't make any decisions today. We looked back at what happened in the last cycle, and people thought that was interesting and informative. But to one degree or another, people noted that this is just a different situation, and those differences should inform the decisions we make about the balance sheet this time. So haven't made any decisions at all about when runoff would start, but we'll be continuing to, in relation to when either liftoff happens or the end of the taper. But those are exactly the decisions we'll be turning to in coming meetings.
Thank you. We'll go to Scott Horsley at NPR.
Thanks, Mr. Chairman. I think you said a few minutes ago that the inflation that we got during the pandemic was not the inflation that you anticipated when you crafted the framework, and you described it as a collision of a lot of monetary and fiscal stimulus with these supply side hiccups. Does that mean
Okay, traders, let's place stop for our position. If it will go lower, we will close position on euro at 112.75. Okay, so you got the strategy. If you follow my trade from this morning, please place your stop at 112.75. We have 500 pounds in our profit in our pocket if it will be closed at this level. But we're still holding. Don't sell your position. Just place your stop for this position and wait. Maybe we will move our profit even higher. You never know. Okay, guys. Okay, I will change to this, let's say, yellow color. I'll speak to you later, guys.
No one had seen what it would really look like for an extended period for decades, and we didn't know what the inflationary implications were. Turned out there was barely 2% inflation and no sense that it was gaining momentum and that kind of thing. So we incorporated that into our framework. This is something completely different. That's a situation where you had a very, very high level of employment and low inflation. This is literally the opposite, or it has been the opposite, where we have very high inflation, and we've had it since the labor market was in terrible shape. It had nothing. So far, this inflation has really nothing to do with tightness in the labor market. It does have to do with strong demand, and strong demand was supported by the Fed. It was supported by Congress. I'm not making any judgments on Congress. It's not my job, but I will just say we're coming out of what we certainly hope will be a once in a lifetime, certainly historic, the first really global modern pandemic, which looked at the beginning like it might cause a global depression. And, so we threw a lot of support at it. And what's coming out now is really strong growth, really strong demand, high incomes and all that kind of thing. People will judge in 25 years whether we overdid it or not. But, the reality is we are where we are. And, we think our policy is the right one for the situation that we're in.
Thank you. Let's go to Brian Chung.
Hi, Chairman Powell. Wanted to ask about the bond markets. When you see the 10-year at 146 basis points, do you have any sort of concerns about an environment by which you might be hiking interest rates into? Would you prefer the curve be a little bit steeper? What are you gleaning from the bond market actions over the last 6 weeks?
So I think the short end actions are easy to understand, which is, they're basically very policy sensitive rates at the short end, and it makes sense that it's reacting to changes in expectations for policy. I think a lot of things go into the long rates, and the place I would start is just look at global sovereign yields around the world. Look at JGBs, look at bunds, and they're so much lower. You can get a much higher yield on U.S. Treasuries by buying USTs rather than bunds, and you can hedge the currency risk back into yen, back into euros, and still be way ahead. So in a way, it's not surprising that there's a lot of demand for U.S. sovereigns in a world, in a risk-free world where they're yielding so much more than bunds or than JGBs. So that's a big part of it. I also think, there may be some assessment in there of what the neutral rate is or what the terminal rate is. I don't know about that, but I would just say that we write down our own estimates of the terminal rate or the neutral rate of interest. Those are highly uncertain, and we'll make policy based on what we're seeing in the economy rather than based on what a model might say the neutral rate is. We all have the experience of the last cycle, where we all through that cycle were trying to estimate what the neutral rate was, and it turned out, I think we learned a lot from seeing what happens. We wound up cutting rates 3 times after raising them to 2.25% to 2.5%. So I'm not troubled by where the long bond is. I see that it's low. We're really focused on broader financial conditions. We're focused on maximum employment and price stability.
Thank you. For the last question, we'll go to Greg Robb.
Thank you very much. Chair Powell, I wanted to give you the opportunity to talk about something I've heard that's been discussed, that, your pivot towards a tighter policy, hawkish policy stance had something to do with the timing of your re-nomination by the president. Thank you.
Sure. Well, I'd be happy to talk about that. So as I mentioned, we got the ECI reading just before the November meeting. We got the labor market report 2 days after the meeting, and then 1 week after that, I think on the 12th of November, we got the CPI reading. It was really the CPI reading in concert with those two. And I just came to the view over that weekend that we needed to speed up the taper, and we started working on that. That's a full 10 days or so before the president made a decision on renominating me. So honestly, it had nothing to do with that at all. And I just thought, this is what we got to do. My colleagues were out talking about a faster taper, and that doesn't happen by accident. They were out talking about a faster taper before the president made his decision. So it's a decision that effectively was in more than in train, and to the point where people were talking about it publicly. So that's what happened, and it had absolutely nothing to do with it whatsoever. We're always going to just do what we think is the right thing, and I certainly will always just do what I think the right thing is for the economy and for the people that we serve.
just a quick follow-up. I guess that some people saying that it was the the stimulus in March that was sort of over. We didn't really need all that stimulus, and that there was talk even then that would be a mistake and it would lead to higher inflation, and perhaps that you didn't push back as much as you might have otherwise.
I didn't push back at all. And the reason I didn't, and there was lots of talk about that, but not from the Fed, because that is not our job. We are not the CBO, and we're not elected by anybody. So we take fiscal policy as it arrives at our front door, and we don't comment. We make our own assessments inside the Fed, but it's really not our role. And I think it's very important that we stay out of that business. No matter who's in the White House, who's in Congress, it's just not our job, and it's something we avoid pretty assiduously.
Thank you.
Thank you.
Thank you, Mr. Chair. Thank you, everyone.
Chairman Powell wrapping up that news conference from New York City on TV and on radio. Let's get straight to this price action because we've got a pickup right now in the equity market. On the S&P 500 up by 1.25%. On the NASDAQ up by 1.63%. If you switch up the board and get to the bond market, 2s, 10s and 30s shaping up as follows. 2-year yields off the highs up by just 2 or 3 basis points now to 0.6832%. On 10s up 3, Tom, to 147.18 and up about 4 on 30s to 186. 47.
I think the bond market move here is interesting, John, but what's so interesting to me was the third leg up in the equity market. He went out and had the courage to look at the x-axis and go out to 2023, 4, and even 25, and boom, the NASDAQ took off.
I don't want to get too cute about this, Lisa, but just digging deeper into fixed income, we're talking about tightening. I don't see much of it in this market right now. Real yields on 10s, they roll over. They roll over through that news conference. Break-evens pick up. They accelerate that pickup through that news conference. Isn't there some signal there?
And just to pick up on that, we were talking about that just moments ago. The implication of longer-term inflation break-evens going up is that the Fed will not cut off inflation as much as people previously thought. And that is the trend that you saw. And I wonder why. What did he say? He was talking about accelerating the taper. He's talking about possibly hiking rates soon after March. And yet the market took this dovishly. Is that possible to say?
Kind of, in the news conference at least. A hawkish flavour to the ultimate decision. But in the news conference, Tom, if we were positioning for a hawkish presser, look, if you're going to mark to market, it's hard to say we just got one, isn't it? The S&P 500 up by 1.25%. Tom, I'll say it again, we're talking about tightening. Do you see much of that in this market right now?
He had the courage, and I'll talk to Bill Dudley about this in a moment, John. He had the courage to extend out the vision, to say to the market, it's not where we are 1 week, 1 quarter, even a set of months from now. It's about a longer-term view by this institution.
Well, as far as he's concerned, Tom, something changed in a weekend. Certainly something's changed in a single meeting. There's a shift in emphasis here away from, say, the labour market towards inflation. Take a listen to what the chairman had to say about the possibility that they could hike before we reach full employment.
In situations in which the pursuit of the maximum employment goal and the price stability goal are not complementary, we have to take account of the distance from the goal and the speed at which we're approaching it. And so that is in effect an off-ramp which could, in concept, be taken, and it's in our framework. It's been in our framework a long time. I've talked about it on a number of occasions. It is a provision that would enable us to, in this case, because of high inflation, move before achieving maximum employment.
Chairman Powell there, Mike McKee joins us following this news conference. Mike, your reaction to all of that in the past 60 minutes?
Well, it does come out a little more hawkish than we had anticipated, with the Fed saying there would be 3 rate increases next year. He did not answer my question about whether that's an if, not a when. It does seem that they are in train to do that. I'm not so sure that the rise in break-evens is telling us a whole lot at this point. I would want to see it over a couple of days rather than a positioning move, because the market is basically getting what it had been asking for. The Fed to start taking the idea of inflation seriously. The Fed has definitely pivoted here and is ready to do that. They're not admitting that they're behind the curve, but 3 rate increases and speeding up the taper suggests they do have some concerns about that.
Mike McKee, Alan Greenspan would suggest the market would suggest what the Fed should do. The market right now is suggesting that Jerome Powell had a very successful press conference. Why?
Well, I think basically he ratified what the market was expecting. There were no surprises, and that's part of the function of Fed communications that they have worked very hard on doing. They don't want to surprise the markets. They came in a little bit more hawkish, but not in a way that would be outside the bounds of what was expected by people on the trading desks, and it does not suggest at all that he did not suggest at all that he thinks we're really going to have a problem with growth or employment. He had the usual cautions about the virus, but he said the economy is strong. So there was nothing in there that would really scare people or color outside the lines.
Mike McKee, thank you so much, and we'll continue with us here in our coverage. He has driven the dialogue of those worried about inflation, perhaps with the...
Okay, traders, let's move on and let's move our stop even higher. See what I mean when I said don't sell yet, because we might move higher our stop. Let's place our stop for our position at 112.80. Okay, guys, £1,000 in profit. And I will adjust. Stay with me. You got the strategy. You know how to place your stop and how we do that. If you don't have a strategy, you need to get from company.co.uk. So stay with me and let's follow this nice line of profit that we still didn't finish and we still didn't close this position, and we will see. Maybe we will move even higher our profit. And then anyway, we still have £1,000 in profit. I'll speak to you later.
Time over this period. So in my mind, it's a little bit of a magical forecast. What I took away from the press conference was that Powell's pretty upbeat about the economy. He really mentioned the strength of the economy, the strength of the labor market, the surprise on how fast the labor market is tightening. I think that the press conference, in my mind, suggested that the Fed is quite a bit closer to actually lifting off, and obviously they've cleared the decks a little bit for that by accelerating the taper. So I think the March meeting is potentially live for a rate hike.
Interesting, Bill.
Interesting. Wow.
Well, let's talk about the possibility of tightening financial conditions then, Bill, because right now, equities off to the races on the S&P up by 1.25%. You and I have talked about this over the last few months, how much work they'd need to do to actually see some tightening. When does higher interest rates actually mean tightening, Bill? How much higher?
Well, I think, today it's hard to know what to make of the reaction of the markets. I think some of it is that the whole Fomc meeting and the press conference is a risk event for markets. And when then Powell delivers pretty much what's expected, it's sort of risk can go back on again and markets can go up. But I think you're raising a very important point. If the economy is growing at above trend and inflation is above the Fed's objective and the labor market is tightening very quickly, how does the Fed actually slow the economy? They have to make financial conditions tighter. And as you point out correctly, that certainly isn't happening today, and it hasn't happened over the last few months. And the reality is, even though the Fed has pivoted, even as we speak, they're still adding accommodation. The taper isn't going to be over until the middle of March.
Bill, do you think that there was a shift, though, in tone where Jay Powell will be more amenable to the idea of a sell-off? I mean, his comments about financial conditions changing very quickly and can affect the economy very quickly, does that support the idea of a Fed put or reject it?
Well, what he's saying is that financial conditions can actually exert their effect on the economy relatively rapidly. He was responding to the question about the long and variable lags of monetary policy. He's absolutely right. If people anticipate that the Fed's going to be more hawkish and view that as appropriate, then that will feed into bond yields in the stock market. But clearly that hasn't happened yet. So I think all that what we're left with today is that there's still quite a bit of work for the Federal Reserve to do to actually exert tighter financial conditions to slow down the economy. The other thing I thought was interesting about the press conference was the emphasis on the wages. In other words, he highlighted the employment cost index report. He basically talked about the wage trend is going to be very, very important for them to assess whether they actually have a persistent inflation problem. So I think the next few readings that we get in terms of wages will be important about whether it's really realistic to expect that inflation is going to magically melt back towards the Fed's 2% objective or not.
Bill Dudley, on your watch at the New York Fed, was the foreign exchange operations, the tradition that the New York Fed monitors the dollar and monitors our relationships worldwide. At this moment, with this market melt up we're seeing, how much is Jerome Powell central banker to the world?
Well, obviously, what the Fed does, affects the entire global financial landscape. Dollar is a reserve currency, and obviously, the U.S. economy is a pretty important economy. So I think it definitely has consequences for the rest of the world. I don't see anything in the market reaction today that's going to create a lot of stress in terms of foreign economies. If and when the Fed begins to tighten, which might happen as early as March, I think that will put pressure on emerging market economies because it could lead to a reversal of capital inflows to outflows and could put more pressure on those countries.
Bill Dudley, thank you for joining us again and your commitment to Bloomberg surveillance. We really, really appreciate it. I look at this John Farrow, and it sets us up with the former president of the New York Fed to go to someone really in the nexus of what financial markets do in the coming weeks.
There's a lot to talk about right now. Let's get straight to it with Jeff Rosenberg of BlackRock. Jeff, let's get to it in this market right now. Your response, please, sir.
Well, you guys have really covered it well. I mean, the initial reaction is hawkish, and then there's a complete reversal. And the metric that I would focus on is the 5-year, the short end, real interest rates. They had a complete reversal. Right now, they're lower than where we were going into the meeting, and that's really, yes, there's a lot of setup. Bill Dudley, I agree with everything he said about this being a risk event, but you look at what's coming out post-press conference, and you see lower front-end real rates and a steepening nominal bond curve. And basically, the market, I think, is reacting to, pretty, off of the hawkish surprise with the 3 hikes. The press conference was not as hawkish, just what Mike McKee said. Markets were not surprised in a negative way. And so what you're left with is, maybe they'll do a little bit, but they're not going to do so much to knock the supportive Fed off of supporting financial markets. That's at least the initial read here.
Is this a good result, Jeff, for the Federal Reserve, or does it make its job harder because it has to take some harsher steps in order to actually tighten financial conditions?
Yeah, I don't know, Lisa. It's a real problem. The Fed has really 3 goals. They talk about the 2, maximum employment, stable prices, but they've introduced financial stability as a 3rd goal. And really, those 2 goals, inflation and financial stability, are setting up to be in stark conflict. And I think the market is voting on today is that they're gonna preference financial stability over fighting inflation. We'll see whether or not that turns out, but I think that's setting the Fed up for a very difficult policy tightening environment next year as they begin this process of trying to deal with this inflation that they're behind on.
Jeff, what does duration do? What is going to be the movable bet on where the central maturity is that everybody buys in the next 6 months or so? Do we extend duration given all this?
Well, I think if you're, holding duration, it's a much harder outlook.
Exactly,
and we've had this outlook for a while because of the negative price return impact without the offsetting cushion from a high enough starting level of income. We'll eventually get the bond market back to a better place, but that transition associated with Fed policy normalization is going to be a tough environment outright for duration. In a balanced portfolio context, certainly duration has a place, but how much? Today it's probably lower because you're facing that prospect of higher interest rates.
Hey, Jeff, great work, as always. Thanks for everything this year. Just brilliant. Jeff Rosenberg there, of BlackRock. Your equity market up by about 1.25% on the S&P. Taking you into the close. Let's get to Romain. Hey, Romain.
Yeah, drifting higher as we get closer to the close. The big thing, we talked about the big risk here in the market. We learned today, at least based on the price action, that the big risk was inflation. The market seems to think that Jay Powell has it under control. Apple flipping from red to green right now, just a few ticks away from a record high. Nvidia flipping from red to green, just a few ticks away from a record high. Even some of the bank stocks that were down in the red a little bit earlier today, now starting to get a bid, particularly some of those banks that are much more sensitive to the interest rate environment. KeyCorp up 1.5% on the day. If you're looking for any laggards out there, you're really not going to find any. 10 of the 11 sectors right now are in the green. The only sector right now in the red are energy stocks. Devon Energy down 0.7% as we head into the close.
Romain, looking forward to it. Romain Bostic coming up on the close a little bit later with Tom Keene, Elisa Bravitz and Jonathan Ferro. TK, is it year over? Can I go now?
No, the Euro's not over. I'm going to be here tomorrow.
You're going to be
We're
here?
Drive forward the conversation.
Lisa's going to be here too.
And you know what?
I'll miss the two of you.
No, maybe not. If the Bank of England raises rates,
I'll give you a phone
John
interview.
Farrow has promised a phoner. Period.
I will give you a phoner. No problem.
Okay.
Will you be satisfied with that?
Well, the one in the Gulf Stream works, John. I mean, you know, the phone in the Gulf Stream works. I know
TK, I'll see Lisa before year end. It's good to see you, sir. I'll see you in the new year. From New York City. This was the Fed show. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. 13 minutes to go ahead of the closing bell. The Dow, the S&P, NASDAQ all advancing on this Fed Wednesday. This update brought to you by SEI. Challenges highlight one's character, partnership, and resilience. At SEI, they act as one community with their clients. Go to SEIC.com/banks. You heard it right here on Bloomberg Radio. Stocks rallied on speculation that the Federal Reserve will effectively combat surging prices without choking off economic growth. S&P extending gains after initially dropping when the Fed statement came out. S&P up now by 53 points, up 1.2%. The Dow rallying 263, up 0.7. NASDAQ up 238, up 1.6%. The NASDAQ 100 index up 1.7%. Tenured on 5/30 seconds, 10-year yield 1.45%. Gold up $6 the ounce, up 0.3% to $17.76, while West Texas Intermediate crude is up 1%, $71.42 a barrel. So an update, here's Fed Chair Jay Powell at the news conference, responding to a question from our Michael McKee discussing the inflation outlook.
There's a real risk now, I believe, that inflation may be more persistent, and that may be putting inflation expectations under pressure, and that the risk of higher inflation becoming entrenched has increased. It's certainly increased. I don't think it's high at this moment, but I think it's increased, and I think that's part of the reason behind our move today, is to put ourselves in a position to be able to deal with that risk. And I think we are in a position to deal with that risk.
And again, 10-year yield right now, 1.45%. Lowe's delivered a revenue outlook that missed analyst estimates, also says it expects home improvement demand to wane next year, but Lowe's shares, they're up now by 1.7%. Rival Home Depot also higher, up by 1%. Among the names reporting after the closing bell, the home builder Lennar. Lennar shares up now by 0.8%. Recapping Fed Wednesday and a rally underway with the S&P up 55 now, up 1.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a twin.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Gotta say, I love Fed Days. Incredible coverage, simulcast on TV, radio from our Bloomberg surveillance team. And right now, as you just heard from Charlie, equities just coming off their highs of the session following that Fed decision. And as we look at the yield curve, we have seen a flattening. But what's interesting is we're seeing yields pop down after hitting some higher levels earlier. So let's get to it. Let's get to the drive to the close.
Nadia Lavelle is a senior equity strategist at UBS Global Wealth Management. She joins us on the phone from New York City. Nadia Lavelle, how are you doing, first of all? And second of all, give us your immediate reaction to what we heard from Fed Chair Powell and the FOMC.
I'm doing well, and so is the market. I think.
How come? Why is the market so excited about this, especially the equity markets?
Exactly. The Fed delivered more or less what was already priced in, an acceleration in its asset tapering program, as well as the messaging around inflation, that the Fed is conscious of the high inflation and will do what it can to keep that in mind.
In other words, they get it.
They get it. They get it. They get it that inflation has accelerated. It's lasting longer than anyone had initially thought. But they will thread that needle very carefully to manage inflation, but at the same time not stifle economic growth.
I mean, is it safe to say we have seen this Jay Powell? He gets it. He's got the playbook. We've got his playbook. It's not the mistakes made, what was it, in 2018, right? When we saw tantrum of the markets. He understands, I think, to some extent, spoon-feeding the markets, getting markets ready. I do wonder about that congressional testimony, getting rid of that word transitory. That was a great thing to get out of the conversation, the narrative ahead of this Fed meeting.
I could agree more. And we'd heard from various governors over the last couple of weeks. So the market was kind of prepared for what was going to happen today. And I think that's why you're seeing a rally in the market, to know that the Fed gets it and is on top of it.
So one thing I think is a really smart question, and some of our guests that we've had on Bloomberg and Radio and Bloomberg TV as we did the Fed coverage today, is any chance that the Fed, though, is not focusing close enough on that yield curve? And there have been individuals, Scott Meinert, I should say, of Guggenheim, on Bloomberg TV and Radio earlier, talking about the potential for a recession, not next year, but the year after. We've had guests where that's a concern, that, you see that flattening, concerns about an inverted yield curve. Is that on your radar at all? Is that something that needs to be part of the conversation?
That remains on our radar. Of course, we're always paying very close attention to the yield curve, because when the yield curve historically has inverted, that does signal a recession is on the horizon. But we do expect that the yield curve will start to re-steepen, particularly as the Fed starts to look to raise rates next year. We think that the 10-year will start to move back up closer to 2%, and that will allow for some steepening of the curve.
Any surprises from the FOMC today?
No real surprises, again, in line with sort of our expectation. I think that we were looking for a little bit more color about what exactly maximum employment looks like. I think that the Fed, of course, is, again, trying to be balanced in comments around that. But we believe that we will get to maximum employment by the time we get to the second half of next year. And we also believe that inflation will start to normalize when we get in the back half of the next year, particularly as supply chain imbalances sort of resolve themselves.
Hey, Nadia, technology off and running. If I look at the 11 major industry groups in the S&P 500, information technology by a mile at the top of that list, up 2.4%. We saw a pop when it comes to the tech trade. The NASDAQ right now is up almost 2%, certainly outperforming both the S&P and the Dow at this point. You at UBS Global Wealth, you are there to help develop the overall equity views, determine sector size and style preferences. Would you be advising your clients to get into some of those big tech names, get into information technology, even if we're going to start to get higher rates, which have normally been a reason to maybe pause when it comes to some of those names?
So we are neutral on tech for exactly some of those reasons that you pointed out, in terms of our expectations for higher yields next year, and our expectations for the Fed to start to increase short-term rates, and that will create some headwinds from a valuation standpoint. I think some of the pop that you're seeing in tech today, remember, tech has been weak for the past few days on concerns around the Fed, as well as in terms of just overall concerns in the market and where valuations are for tech companies. But we do think that some of what you're seeing today is also probably a response to potential slowdown in economic growth near term around the new variant.
What do you mean by that? How are you seeing that play out in the trade?
Yes, as we know, like all year, we have seen this rotation happening when people get concerns around the Delta variant tech rally. There's some concerns in the market around also helping tech to rally today. So it's a combination of.
Hey, could you repeat that? Could you repeat that, Nadia? We had a little bit of a tech snafu. Could you just repeat what you just said?
Absolutely. What I was saying is that I think some of what you're seeing today, tech has become also a safe haven when people become concerned around an economic slowdown. And there's some concern in the market around the Omicron variant.
Interesting. Perhaps that explains a little bit of Apple's surge this afternoon.
Exactly. People are hiding. The market is somewhat hiding in some of these tech names as well.
It's amazing, Apple becoming a safe haven, Carol.
Well, you know, it's funny. How do we look at these companies that have become so entrenched in our life? We all joke about not going anywhere without our phone. It's just pretty remarkable. So is it a staple? Is it a high-tech device? Is it a piece of technology? Is it telecommunications? I mean, this is something, to quote Kathy Wood and some others, but she in particular, about these companies that are cross-sections of kind of our traditional sectors. And so as an analyst, as a market watcher, you have to think of them in many, many different ways. Same thing we're seeing in the auto sector. Is it technology? Is it an automobile? Like, what are these things? Having said that, Nadia, what's your best case for the equity markets come 2022? Are you guys comfortable putting out a projection there?
Yes, we're actually very constructive on the markets into 2022. We have a price target of 5,000 by the time we get to June of 22 and 5,100 by the end of next year. And on all of that is being really driven by earnings growth. We're looking for low to mid-teens earnings growth for next year. We are looking for a little bit of valuation multiple contraction, about 1 to 2 turns from the current level we're at. We're about 21.5 times.
And do you still anticipate the Fed will start hiking rates in September of 2022, or did anything you hear today change that?
We do. Our official house view ahead of the Fed was that, of course, we are data dependent, just like the Fed.
I've heard that before, data dependent.
Yes. And so, of course, just like the Fed, we will recalibrate as necessary. But our official house view is 1 hike next year. And then into 2023, we were looking for a quarterly cadence in terms of rate hikes.
Where don't you want to be in this marketplace?
Today, and the reason why I brought up tech in terms of being a safe haven, because you're also seeing a rally in utilities and consumer staples, and we know that those are the most defensive sectors within the market. And so those are areas that we continue to avoid. We just think it's too early to pivot to a more defensive tilt. We think that growth remains healthy and will still be the case in 22.
All right, we're going to run. Hey, listen, thank you so much. Really appreciate your input. Nadia Lavelle, Senior Equity Strategist over at UBS Global Wealth Management, Nadia Lovell, on the phone from New York City, breaking down her thoughts on that latest Fed decision. And as we have just a few minutes left in today's trading day, we're pretty much at our best levels of the equity markets. NASDAQ on a tear up 2%, S&P 500 a gain of 1.6%. Interestingly enough, when it comes to the yield curve, we're watching that always key on a Fed day, that 10-year note with a yield of 1.45, 5-year note with a yield of 124, and that 2-year note 0.66. And we are seeing yields certainly a little bit higher prior to what we saw that Fed decision. Coming up next, we'll be joined by our Bloomberg TV team for Beyond the Bell, live on radio, TV, and YouTube. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day, and apparently 2 meetings away from the end of the Fed taper. Romaine Bostick, Taylor Race, Kelly Lyons, counting you down to the closing bell. Here to help take us beyond the bell, our global simulcast partners, Carol Masser and Tim Stenovic, bringing together our Bloomberg television, radio, and YouTube audiences, parsing the most crucial moments of the day. And I assume, Carol, that most crucial moment came around 2 p.m. today.
No doubt about it. It was fascinating to watch the market reaction, right? Initially, equities got a little bit nervous, and then we bounced back. And look at us. We're going to pretty much end at our highs of the session. I heard you talking about Apple earlier on TV. We're watching that that one, take it to tick higher. I mean, that's one of the, I think, outstanding moves is the technology positions, Tim, that we've seen today.
Yeah, speaking of Apple, look at the NASDAQ 100 and the NASDAQ Composite just surging after getting some clarity from the FOMC. I mean, we have to look at this in the context of what happened over the last couple of days where tech got beaten down ahead of what we heard from the Fed today. But certainly investors cheering more clarity here.
And, you know, maybe this is a cold take, you guys, but 2 or 3 of the latest research notes that I've read have said that the market might actually be relieved that the chairman acknowledged that inflation is broadening and that it is here to stay, instead of sort of downplaying it and the market screaming and saying, what do you mean there is no inflation? And at least sort of we got, like you said, Tim, finally clarity from this Federal Reserve.
And we should just point out real quickly, the S&P at one moment here did actually tick above that all-time high.
Yeah, it's interesting to see how equities are reacting positively to what, at least on the surface level, seemed to be a hawkish decision. And of course, it was the dots that were more hawkish, Romaine. But Powell went out of his way to say, as you've been saying, that isn't a commitment or a plan.
Yeah, dots don't matter here. I mean, what he said and how he handled himself at that press conference, that's what everyone was really focused on here. And you said it best, I think, Taylor. The idea that he acknowledged the inflation and he acknowledged that they're ready to fight it. That seems to be what this market is taking comfort in. We're not going to quite get a record high here on the S&P 500. We did trade above that 47.12 level. We're going to close right around 47.08, up about 1.6%. Dow Jones Industrial Average going to close higher by about 1%. The NASDAQ Composite, that's out in front here. All of the big tech stocks really rallying today. Apple closing just shy of its record high at 179. The NASDAQ Composite up 2% on the day. Even the Russell getting in on the party, Carol, up about 1.7%.
Yeah, fascinating to see the run. And the thing is, you know, what's interesting is no one knows exactly where the economy is going to be next year. Jay Powell's saying that specifically. There are still a lot of questions, but he was very upbeat, talking about growth, talking about the economy. How could investors not be a little bit enthusiastic following that Fed reaction and Fed news?
Well, and you're certainly seeing enthusiasm in that a lot of stocks are higher today. Actually, most of the major groups in the S&P 500 did close in positive territory. Up top, semiconductors up 4.3%. Broadly, you see a lot of tech-oriented groups are in the top half of the pile here. Interesting, the only sectors that were lower on the day, banks and energy as well as telecom. Energy, you did see oil coming up off of the lows of the session, and banks, initially we saw that flatter curve. That then reversed, and you actually saw a little bit of steepness. So it's interesting to see that the S&P 500 Banks Index did close lower by about 0.25%, Carol.
All right. So, Kaylee, let's get to some of the gainers. We've talked about Apple, but let's just point it out. Up 2.8%, not getting to that $3 trillion market cap, but nonetheless continuing its march upward here in 2021. So watching that one specifically. And we saw that move right after the Fed statement in some of the big tech names and in Apple specifically. Wanted to mention Eli Lilly, top in the S&P 500.
And we should just point out, too, the record high on Apple is 179.45. So look how close they are.
So close.
Like right there.
Yeah, we
right
did trade right above it, right before the close.
I mean, it's just fascinating to see the move up here in that name. I mean, it's up 35% so far this year. Hey, when it comes to pharmaceutical, we're often talking Pfizer, Moderna. Well, we got to talk about Eli Lilly, up 10.3% in today's trade. Company coming out, it was top in the S&P 500, raising its 2021 earnings and revenue forecast and seeing revenue growth in 2022. I love what the CEO had to say. We're in a great position because we've got rapid underlying growth. There's some fundamentals for you. And they talked about specific drug products in the next few years that will have $1 billion in annual sales. One other name, O'Reilly Automotive, top in the NASDAQ 100. It's unbelievable. It's up about 51% this year. And it hit another record high. We've had a lot of analysts coming out raising their price target on this one. So just thought I'd put that out on your radar. Hey, Tim, what do you got?
As far as decliners look, want to start with Medtronic, down 6% on the day today. The medical products company hitting a 52-week low after it said that its diabetes unit was the subject of a regulatory warning. Medtronic is implementing a range of corrective actions, and the company said it's not recommending any action by patients or their healthcare providers as a result of this letter they received. Roblox in the metaverse down by 9% today. Daily active users for November coming in fewer than expected. That's according to Truist Securities. Down about 30% from that high on November 19th. Also watching Roku, shares falling following the latest development in a patent dispute, this with Universal Electronics. Roku said that it doesn't anticipate any disruption in Roku's ability to continue to import products. Universal saying that Roku devices will be shut from the U.S. market beginning next year. Analysts, though, they're saying that the sell-off is overdone.
And And thank you, Tim. Hate to say it, though, all the action was in the bond market today as we go from some of the winners and losers. And this is really interesting, you guys. We're up 66 basis points here now on a 2-year yield. And rate of change kind of day when we're only up 2, 3, 4 basis points out on the long end. But, Carol, this is where things get interesting. We just had Jonathan Golub here of Credit Suisse saying that it's really weird when that inflation expectation is rising, but yields on the long end aren't following. And is that a yield curve that is seen through some of the, dare I say, transitory nature of this inflation, but long end, 3, 4 years out, really seeing sort of this lower level of inflation really starting to settle in?
Yep. And this is, I think, a big part of the question, right? That everybody wonders, how much is Jay Powell watching what's going on in the yield curve specifically? He did get that in a question towards the end of the Q&A. He's not troubled by where the long bond is. He understands where the short rates are going. But we heard Scott Minerd of Guggenheim talk about an inflation, a recession, not next year, but the following year. And so you do wonder how careful the Fed has to be in being maybe overly aggressive, if the economy starts to slow down.
I think it's the readiness.
We didn't get that today, though.
Yeah, no, we didn't get that. Definitely not out of Jay Powell. And I think you talk about the readiness that he seems to be signaling, and that seems to be what the market's embracing. When he made that first comment early on in the press conference, the idea that there wasn't necessarily going to be a long delay between the end of the taper and the beginning of the rate hike. I mean, you're putting what potentially a March meeting in play, maybe the May meeting at the latest here. The question then becomes does the market get spooked by that? But you saw it actually rally after those comments.
Right. Yeah, it's so interesting. And he also said that the Fed can make a move before they've reached quote unquote maximum employment, that they have that flexibility to act first on inflation. And it's not just about liftoff and rate hikes. The other tools at play as well as tightening and actually rolling off the balance sheet are at play as well.
And he made clear in his comments, though, that when you talk about maximum employment, that inflation was a threat to that.
Well, Wells Fargo saying that, the top of their headline note is inflation check, labor market, we're almost there. And that really is, when you think about the two dynamics, maybe employment isn't fully where it needs to be, but if inflation is posing a threat to that, you have to act.
You remember where we were? It was like December, was it 2018? When he raised rates, it was like the fourth time, and everyone was like, what are you doing? And that was kind of the peak of the cycle. And then we started to come down. Yeah, and it's just amazing, how far we've come full circle here. Obviously, circumstances changed a lot in the economy since then, but it's just amazing how we've come full circle.
Yeah, we just talked to Nadia Lovell of UBS Global Wealth Management, and she basically said the theme from this was, the Fed chair acknowledging inflation was a big part of this and saying, hey, essentially, I get it. And she, by the way, still thinks that September 2022 is when we're going to see the first rate hike, even after today's meeting.
I don't want to throw water on all this.
I'm sorry, what was the date?
September 2022.
Okay.
Markets are looking at 2 to 3 by that point.
All right.
I don't want to we just had Dudley on the Fed special. He's saying that March meeting is a live meeting.
But we don't know. The other thing that I thought was interesting is that Jay Powell said no one knows with certainty where the economy will be 1 year or so from now. Diane Swank also saying before the decision, we have no muscle memory on this economy. We don't know really what happens, what the recovery is. Nobody could have called what happened a year ago or a year and a half ago. Nobody could have called this trajectory.
That's what he's got to say.
I know, it's pretty shocking.
What did you make of the question towards the end of there when they asked him about, I guess, some of the fiscal policies and how that's maybe distorted things for the Fed? He seemed a little, I don't know. I don't want to.
They never like talking about
his place to comment on.
They never like talking about it.
Yeah.
They're like, that's not my job.
Okay, but his body language and his affect was changed.
And it was interesting how that fit into the discussion about labor force participation. And he said, we're not going to get back to where we were February of 2020 and all of the dynamics that are going into people not returning to the labor market. And part of that was people had cash in their wallets. There was fiscal stimulus at play.
And he mentioned high home prices. He mentioned high equity market prices as everyone's looking at their savings account now, and is that a deterrent factor, and is it back to a one working household instead of two? Those were the words that really caught my attention.
Let's also not forget this is happening in the midst of a pandemic and a variant, and he did acknowledge that, of course, and it's a good reminder of what is outside of the control of the Federal Reserve. And he talked about the idea of people getting vaccinated and, of course, that improving the economy. That we've heard time and time again throughout the pandemic.
But he defended consumer spending. He said it's still strong despite that retail print that we had earlier this morning.
That's right. And they lay out policy, and it doesn't mean that they're necessarily going to stick to it. What they say today doesn't necessarily indicate what they're going to say down the road. All right, we got to run. Great conversation. All right, that's going to do it for our market wrap, our Beyond the Bell coverage on Bloomberg Radio, TV, and YouTube. Folks, we'll see you again, same time, same place tomorrow.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Gotta say, that was a fascinating Fed meeting.
It was.
Look,
going into it, we knew that it was, many people were calling it the most important one of the year, and I think it delivered.
Right, he delivered. And, very clear, it isn't the Jay Powell when he started out his tenure. And I think we got a little bit of everything. And I think markets, first of all, I think they like clarity. I think what Taylor said, was it a few weeks ago or something about a new Jay Powell after he did that congressional testimony.
Yeah.
And maybe it's not a new Jay Powell, but he's come out and said, okay, not transitory. Let's stop using that word. Acknowledging that maybe the labor market doesn't go back to where we were. A lot of things, the economy doesn't go back to where we were pre-pandemic.
What about the moment that he was asked about potential politics here, right? He was asked by somebody about, did your tune change on inflation after you were renominated? And I thought his answer was really interesting. He said, no, this is something that, look, people in the Fed had been talking about this. But his answer was he saw the data late in the week, and over the weekend, he really started to think that the Fed had to change its tune when it came to tapering. Because of that data.
We all have those, can I say, come to Jesus moments? I mean, we all have those moments where we, maybe are very firm on something because we've done the research, we've talked to people who are in the know on things and say, okay, this is the way it should go. Historically, I think one of the things we are all realizing is that we have never lived through this period of an economy shutting down so quickly like it did, people pivoting, companies pivoting. I mean, we talk about the remarkable run that we've seen in earnings and profit margins during the pandemic, and then how does it play coming out of it? I don't know. I haven't lived through this before. And so I think we are in a period of discovery every day on this. And maybe Jay Powell just said, you know what, maybe I've got to change my tune a little bit because this has lasted longer. And maybe we need to acknowledge, when inflation was so low for so long, that was another thing that nobody could get, coming off the financial crisis. Mm-hmm. Maybe we stay higher. I don't know. Nobody knows.
Well, it also raises the question, Carol, does it make sense to look on previous cycles because this is just so different than anything we've experienced in our lifetimes before?
Yeah, exactly. I don't know. I think it's really, really tough to figure out. And time will tell on this. And data dependent, the Fed will be.
Ah, there it is, data dependent.
You're listening to Bloomberg Business Week on this Fed Day. This is Bloomberg. All right, so what do you do on a Fed day when we are just obsessed with everything that Jay Powell and company had to say today? You know what we do? We actually go to the 49 most fascinating, mind-blowing, challenging, hilarious, and urgent titles of the year. We're talking about books.
We are talking about books, and this is great because there's some very familiar names on here. It's essentially the best books of 2021. And did you, by the way, how many of these did you read this year, Carol?
I don't know. I'm still going through the list. You're kidding me.
Okay, so they're great.
A very smart individual around here at Bloomberg always comes by my desk and is like, what's with the books on your desk? Like, have you read them all? And
you should tweet a picture by the way, of that desk, okay?
I do love books, and I have a hard time getting rid of them.
You always know where Carol's sitting because there are stacks of books. Ron Barron, for example, the chairman and CEO of Barron Capital, he's recommending Liftoff, Elon Musk, in the desperate early days that launched SpaceX. We hear from people like Danny Meyer, the founder and CEO of Union Square Hospitality Group, of course, Christine Lagarde, too, president of the European Central Bank, Martha Pollack, president at Cornell University, and more.
Dan Schulman, the CEO of PayPal, talking about Green Lights, the book by Matthew McConaughey, which talks about sharing advice on how to navigate life's challenges, how we can take advantage of the opportunities that come to us as green lights. So that's really an interesting one from him. What else do we have?
Nancy Davis, the founder and chief investment officer at Quadratic Capital Management, recommends Melmoth, the novel by Sarah Perry. And we also see Green Lights recommended by Alan Phillips, chief creative officer of Reef. So those are some repeats there. I guess I got to read that McConaughey book.
Did I say McConaughey? Yeah, did I say it right?
Yeah, Matthew McConaughey. I guess I got to read the book. It's being hard to take on a couple of recommendations on this list.
Partly because I find him an interesting individual. I would like to read it too. Jim McKelvey, co-founder of Square, we've talked with him on air. The book that he says, Rationality, What It Is, Why It Seems Scarce, and Why It Matters by Steven Pinker. And he says, reading Dr. Pinker is like eating a flourless chocolate cake, which if you haven't done it, you're not living, folks. He goes, I have to take it slowly, but it's wonderfully satisfying. And it does go really well with some whipped cream on the side.
All right, one more. This one's from Byron Allen, the head of Entertainment Studios. Ghost Boys by Jewel Parker Rhodes is Byron Allen's recommendation.
All right, it's a great list. Check it out at Bloomberg.com. This is Bloomberg Radio.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Fed Wednesday and a major rally for the U.S. stock market. Stocks advanced on speculation the Fed will effectively combat surging prices without choking off economic growth. Now, the S&P extended gains after initially dropping when the Fed statement came out. The S&P finished with an advance of 75 points today, up 1.6%. The Dow up 383, up by 1.1%. NASDAQ up 327 points, up 2.1%. NASDAQ 100 index up 2.4%. Russell 2000 up 1.6%. Dow Transports today up by 0.6%. And the SOX, that is the Philadelphia Stock Exchange's Semiconductor Stock Index, up today by 3.7%. 10-year down 6/32, 10-year yield 1.46%. Spot gold up 0.4%, $17.78 the ounce. Bitcoin up 1.7%, $49,149 on Bitcoin. And West Texas Intermediate crude up 1.2%, $71.59 a barrel. Bottom line here, up day, Fed Wednesday with the S&P up 75, up 1.6%. 10-year yield now 1.46%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. All right, you're listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic. So we got a read on small business optimism yesterday from the NIFB. Optimism up slightly last month. Business owners still concerned, though, about managing challenges such as rampant inflation and supply chain disruptions that are impacting their businesses. Our upcoming guest has a great view when it comes to small business.
Catherine Petralia is the co-founder and president of Cabbage, which is now a company owned by American Express. Catherine joins us on the phone from here in New York. Catherine, how are you?
I'm doing great, thanks. How are you?
We're doing well, thanks. It's good to have you back with us. Hey, I was wondering just how you would characterize how small businesses are feeling right now. We did just hear from Jay Powell, and he talked about what he believes is the strength in the economy and consumers. What's the read that you're getting from small businesses?
Well, we hear a lot from small businesses, and I think small businesses have always been very vulnerable. Most small businesses have fewer than 20 employees. Actually, most of them have fewer than 10. So they tend to be subject to the whims and fancies of the economy and other circumstances more than, traditional large businesses. So what we're hearing from them is they're feeling like they're getting out of the pandemic from a hiring and maintaining their staff perspective. By the same token, there are a lot of things that are stressing them, such as access to human capital, as well as potentially rising interest rates, and as you mentioned, supply chain.
Help me understand too, Catherine, rising rates, because even if rates go up a little bit, we're still pretty much low at historical levels, but even a small move for a small business, I guess, can be problematic. But give us some perspective on what even a slight raise in interest rates means for a small business, and a small business, as you said, can mean just a few people.
Well, I think it does sort of ricochet through the economy. It's not necessarily like the capital that small businesses access gets more expensive. There's not a one-to-one relationship there. But you do potentially see pressure on supply chain, for example, when interest rates change, and especially if potentially businesses rely on a lot of international trade to get access to the products that they...
Okay, traders, what I want to say that I'm going to cancel the order. I will hold this order until the end of trading day. If it will not get filled, I will cancel it because we're still holding several positions, long positions on euro, and we need to close them in profit. So this position, it will be hedged towards our losing positions. If you don't understand how we trade, you need to get a strategy. For people, for our clients, for our customers who already knows how we trade, who use our strategy, you know what I'm trying to say, what I'm talking about. So let's see if in how long, if in 40 minutes we will not get executed with this position, and if we will not get filled, I will cancel the order until tomorrow, and we will see what's going to happen tomorrow. Okay, for time being, we are in profit, £1,000, and then we will see where it will lead us tonight. For all of you guys, if you just joined, for let's say this morning, if you decided to follow this trade, hold this position, and if you want to move further, let's say you can move to 112.85. If you want to close this day trade today, it will give you the profit. Depends how much you invested. You need to check per pip, how much broker pays you per pip. Okay, guys? I'll speak to you later.
Platform that includes checking accounts, it includes payment processing, and of course like I said, the flagship line of credit product.
Help us understand help us understand the fees and how they're variable and how much a business pays for this line of credit.
Well, the lines range between $1,000 and $150,000. It's a little bit difficult to talk about fees specifically because not only is it based on that particular business's risk profile, it also depends on how long they borrow. Something that's unique to us is we always disclose to the customer what the fees are they will pay in dollars and as a percent. And they pay less when they keep their loan for a shorter period of time because they're only paying fees on money that they have borrowed. And that does make calculating an APR specifically a little more challenging.
Hey, Catherine, just in the minute that we have left with you, help us understand where you saw the need for this and especially with the development of Cabbage. What was the example that you saw? Like, who is this perfect for?
You know, we started out with e-commerce customers, 12 years ago, but then we realized all small businesses need access to ready capital and they weren't getting it from their banks. And it's because the smaller businesses are simply harder to serve. But through the real-time, technology that we've built, this cash flow platform is able to analyze cash flow for a small business, in just a minute, and we're able to identify exactly what the customer will qualify for, and they're able to understand that they qualified right away. And time is the one commodity always in short supply for a small business, and we aim to make this the least time-intensive process of their day.
All right, we're going to leave it on that note. Hey, good luck with it, and love to hear how it's going in the future. Catherine Petralia, she's co-founder and president of Cabbage, now, of course, owned by American Express, based in Atlanta, Georgia, but on the phone in New York City on this Fed Wednesday.
Interesting to get that read on small business, especially after hearing from Fed Chair Powell.
Yeah, I mean, listen, so important to our economy. We know it. When you think about supply chain, so many smaller businesses are involved in the supply chain. So we need to keep an eye on the health of them and what they're doing.
Can't help but be reminded, though, that when it comes to what is out of the Fed's control, the idea of another variant, potentially, think about what's happened over the last 18 months. A factory shuts down in China for the repercussions that has along the supply chain.
Exactly.
That's not in the control of the Fed.
No, which is something really important for us to keep in mind as we get ready to wrap up this year. Hey, folks, you're listening to Bloomberg Business Week. This is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Helps if I push the button.
You got to press the button, Carol.
I'm just like still off my game after the Fed meeting. This story that we're going to get to in just a moment, most read, it's the Bloomberg Big Take, deep dive into what's going on right now, which is largely an unvaccinated pandemic.
Yeah, our own Drew Armstrong, senior editor for U.S. Healthcare, spent some time in a hospital in Kentucky, and he wrote about, among other things, what he found there. We're going to talk to him in just a few minutes. In the meantime, a check of how that trading day ended up and business news. Here's Charlie Pellet.
Higher across the board. Thank you, Tim. Deep dive right now into what happened on Wall Street today. Stocks rallied on speculation that the Fed will effectively combat surging prices without choking off economic growth. The S&P 500 extended gains after initially dropping when the Fed statement came out. 2 o'clock Wall Street time. NASDAQ 100 index up today by 2.35%. NASDAQ Composite Index up 327, up by 2.1%. S&P close to a record, up 75 today, up 1.6%. The Dow up 383, up 1.1%. 10-year yield 1.45%. Spot gold up 0.4%, 1777 the ounce. Bitcoin up 1.9% at 49,213. West Texas Intermediate crude up 1%, 71.44 a barrel. Well, at the news conference broadcast live right here on Bloomberg Radio, Powell covered a lot of ground, including COVID.
The rise in COVID cases in recent weeks, along with the emergence of the Omicron variant, pose risks to the outlook. Notwithstanding the effects of the virus and supply constraints, FOMC participants continue to foresee rapid growth.
Reaction to today's Fed decision, the news conference, and market response from Nadia Lovell, senior U.S. equity strategist at UBS Global Wealth Management, who is our guest right here on Bloomberg Business Week.
The Fed delivered more or less what was already priced in, an acceleration in its asset tapering program, as well as the messaging around inflation, that the Fed is conscious of the higher inflation and will do what it can to keep that in mind.
Lowe's delivered a revenue outlook that missed analyst estimates. Instead, it expects home improvement demand to slow next year. Lowe's shares did advance today by 2%. Rival Home Depot up by 1.4%. We are awaiting the latest numbers out of home builder Lennar. Recapping 10-year yield on this Fed Wednesday, 1.45%. S&P up 75, up 1.6%. And that's a Bloomberg Business Flash.
All right, Charlie, thank you. Well, this next story, it's among our most read on the Bloomberg. It is also the Bloomberg Big Take on the Bloomberg terminal. We head to Kentucky and one hospital system that illustrates how the pandemic has become one largely of the unvaccinated and one that continues to push hospital systems, Tim, past the brink.
Drew Armstrong is senior editor for U.S. Healthcare for Bloomberg News. He's with us in the Bloomberg Interactive Broker Studio. Drew, you spent some time in a hospital in Kentucky, and you write about what you found, along with a lot of other parts of the story. Just describe what you saw when you were in the COVID ward there.
Yeah, I was actually in 3 different hospitals in Kentucky, 2 in the eastern part of the state, regional hospitals, anywhere from 100 to 200 beds, the type of places that, not the smallest hospitals in the state, but certainly not the largest. And then also at the University of Kentucky, which is just the big, giant academic medical center there. I talked to a lot of their staff, their doctors, and their nurses. This was just as they were coming off the biggest COVID wave to hit the state. And
this was the Delta wave,
This
right?
was the Delta variant that they got hit with over the summer. And I was really interested in what happens when a region or a state, in this case Kentucky, where some places are pretty well vaccinated, some places are quite poorly vaccinated. What happens when it gets hit with a big wave of COVID cases like we're seeing happen right now in Michigan, in upstate New York, in Minnesota, in Ohio? All these places are in the headlines right now. And how that kind of pushes and pulls on a healthcare system. And what you see is, first of all, they still have COVID patients who are in the hospital there. And these people are very, very sick. I mean, they had a patient code, which means either their heart or their lungs stopped working. While I was there, finishing up an interview with one of the doctors, she went sprinting down the hall to take care of her patient. But I think, you see these people and how ill they are. I mean, I sat outside a room, one of the isolation rooms, and watched a man on a high-flow oxygen mask, and he is, gasping for breath into this thing. But he's taking these little gulps of air, and there's no way other to say it is that it looks like this person is suffocating to death right in front of your eyes, and that is what this disease does. And you saw patients on ventilators, patients on heart-lung bypass machines. It is really horrific. And then outside the hospital, it's like nothing's ever happened.
I have a million questions. First of all, it reminds us that, we're far from being over this pandemic, right? And it still impacts these people, largely unvaccinated people?
Yeah, almost all of them are. It was interesting to talk to the caregivers in this case, because they said the first wave that they dealt with, pretty much everybody in the hospital, old, frail, exactly the people you would think would be hard hit by a respiratory disease.
This is before the vaccine.
Yeah, this is over the winter. This was last winter, about a year ago, when the whole pre-vaccine vulnerable population. This time around, they said these are the young people, 30s, 40s, 50s, type of relatively healthy people. Typical Americans you'd see walking around there in the Walmart or the Kroger. And those were the people that were in the hospital this time. And because that's really who the unvaccinated are in Kentucky as well. I mean, you look at the vaccination rates, you have a county, let's say it has a 40% vaccination rate. That's really a lie, because that's almost all the older population. The younger groups are very, very unvaccinated there.
When I was reading this piece, Drew, one big takeaway for me was what happens to a health system when it is overwhelmed. You write about a policy that has only been invoked a few times at one of the hospitals, where they essentially tell an incoming ambulance that, hey, we don't have any room here for your patient. You have to take this patient somewhere else. Talk a little bit about the toll this takes on healthcare workers, the toll this takes on hospitals, and how somebody who may have a heart attack, who may have a stroke, something completely unrelated to COVID, might actually die as a result of a hospital being overwhelmed from COVID patients who potentially aren't vaccinated.
Yeah, just to set this up, I think it's important to remember that, U.S. healthcare and hospitals in particular, it's not like they have a ton of excess capacity. These are businesses, whether they're nonprofits or for-profits. These are businesses, they run pretty lean.
And we run on an assumption that if we walk into a hospital, we're going to be taken care of.
And you typically will be.
Right.
But they do that by kind of very carefully running it around, 80 or 90% capacity all the time. There is not a lot of extra room. The system is built for a disaster, but it's built for a disaster like a chemical plant explosion or a big crash on the interstate, where it's, people come in, they get hurt, and they're out. And it's also built for patients who come in the hospital and then leave the hospital. And that's really critical because, a patient who gets sick and comes into the ICU, they're typically in there for, a few days. These COVID patients sit in these beds for weeks. And so, hospitals do have an option when things are getting really bad. As Tim mentioned, they do what's called going on divert. Send out a message to all the local ambulances, say, don't come here, go to the hospital 30 minutes down the road. Now, and that's a case where the ER is so backed up, they're saying, we can't take anybody, we got to hit pause for a few hours. Now, what happens, though, when your ER is overwhelmed with COVID patients? The ER down the road is overwhelmed with COVID patients. The ER down the road from that is overwhelmed with COVID patients, because that's what happened there. And they went on, this is a hospital in London, Kentucky. It's about 75 miles south of Lexington. They serve a lot of Appalachian counties. And they'd gone on divert. It was the third or fourth time that they'd gone on divert in August. Before that, 20 years, they'd only gone on divert twice. Once was a bomb threat, the other time was a tornado. And they were on divert once again because they had 30 people backed up in the waiting room, and they had another, 20 or 30 people in the ER waiting for beds upstairs who needed to be admitted. They went on divert, and then they did it for 2 hours, and they looked around the rest of the region. They said, all the hospitals around us are on divert as well because they're overwhelmed with COVID patients. They said, we can't do this. They turned it off. They said, come in. We'll take care of these people the best we can. Just bring them here. Now, the consequences of that, though, is that these COVID patients are streaming into the hospital. So are car accidents, so are strokes, so are heart attacks. And, they've been told by places like University of Kentucky, which is, the big transfer center, they get the really complex stuff, the nasty things. If you have a stroke in Kentucky and it's a bad one, you're going to UK probably. You're going to get stabilized at one of these places and then sent to UK for neurosurgery. Well, they had patients, they told me, that had to wait. I need to say something about a stroke. You have a stroke, you're talking hours in advance to get care. This is permanent disability. A clock is ticking. They had patients, they told me, that waited for over a day to get transferred.
this is, we'll put it on our Twitter feed if you haven't seen it. It's definitely at Bloomberg.com. Drew, thank you so much. Some amazing reporting from Drew Armstrong, Senior Editor for U.S. Healthcare at Bloomberg News. Quick headline, Qantas picking Airbus to replace Boeing 737s in domestic fleet. This is Bloomberg. All right, you are listening to Bloomberg Business Week. Carol Master along with Tim Stanovich. Just to remind, like that story we just did with Drew, we are going to put it on our Twitter feed because it's why so many have been concerned about, even in a slight uptick in COVID cases, these hospital systems, as Drew mentioned, they're businesses, and they have business models about how many beds are around and available, and it doesn't take much to all of a sudden them to be squeezed in terms of capacity, and then you do wonder about people who walk in with heart problems or a stroke, and then they can't be taken care of.
It's also today's Big Take, available at Bloomberg.com, and you can find it by typing in NI Big Take 2 on the Bloomberg terminal. Carol, it makes me think of, and Drew talks about this a little bit in his piece, the idea between personal freedom and liberty, and the idea of if we're not getting a shot in the way that people say it's my choice because of my liberty, but at the same time, if you are then put in the hospital and you're straining the healthcare system and making it so people who get in a car accident can't be treated, then it is something that affects other people. If you're passing it to other people, that's something that affects other people as well.
Yeah, absolutely. I mean, right? Like, how much have we talked about community during this whole pandemic, that you need to think about how your actions impact your family, your colleagues, work or other, your friends, because, and this is what's tricky. I have had so many people come up to me like, yeah, I've had COVID. I've had COVID twice. I'm fine. And then you have so many other individuals who get COVID and they're not fine. Right. And so this is the tricky part. We are largely seeing, though, as Drew pointed out, it's people who are unvaccinated, who are really, getting sick and needing to be hospitalized. And that is stressing our system, certainly seeing that in parts of the country.
Hey, I wanted to bring our attention to a story about JP Morgan because we are seeing some big changes happen for conferences that were supposed to happen in person. We learned today that JP Morgan is going to bring its annual healthcare conference online after Moderna and Amgen said that they wouldn't fly employees in for the event in San Francisco.
Very important if you think about it too on a Fed day, when it's just a reminder that COVID is impacting our society and it can also impact it when it comes to the economic outlook.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet, just getting the latest quarterly numbers out of the home builder Lennar. It's forecasting new orders for the first quarter, but that guidance did miss the average analyst estimate. Lennar shares now lower after hours, down by about 4.5%. Airbus poised to sweep a multi-billion-dollar aircraft order from Qantas in a blow to Boeing and its 737 MAX narrow-body jet. This, according to sources. Boeing shares were little changed today. BA on the ticker, down by less than 0.1%. Big move higher for the Dow, the S&P, and NASDAQ, with the S&P up 75 on this Fed Wednesday, up 1.6%. The Dow rallied 383 points, up 1.1%. NASDAQ up 327, up 2.15%. 10-year yield 1.45%. Stocks closed near records after initially dropping when the Fed statement came out. Today, stocks advanced on speculation that the Fed will effectively combat surging prices without choking off economic growth. Spot gold up 0.4%, $17.77 the ounce. West Texas Intermediate crude up 1.3%, $71.62 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week. Carol Massar along with Tim Stanovic. Well, launched in 2018, it's a sweeping effort by the Department of Justice, the FBI, and other federal agencies to counter Chinese espionage in America's corporations and research labs. The goal, rooting out spies and halting the transfer of information technology to China. So is it working? And what impact has it had on the individuals targeted by that sweeping effort? Here with that story is Bloomberg News senior investigations writer Sheridan Prasso on the phone in Washington, D.C., along with Bloomberg Business Week editor Joel Weber in our New York bureau. This story on the Bloomberg terminal and also online at businessweek.com. Joel, interesting. I feel like we haven't talked about this a lot, but it does bear like looking at the program and finding out, did it do what it set out to do?
Which is exactly what Sherry told us she wanted to do a bit ago, and we said, go forth and tell us what you find. And, you know, it really does come down to this idea that the U.S. was on a hunt for Chinese spies, but ultimately that hunt has proven rather fruitless. But Sherry, take us inside the program. What'd you learn?
So I looked at the indictments that had been announced or unsealed since the China Initiative was launched in 2018, and this was a big sweeping effort. The FBI got up, the FBI director got up, the head of the Department of Justice got up. They all said, this is a huge problem. China is stealing our state secrets and taking them back to China. We are going to root this out of America with a big sweeping effort to do so. Now, only about 50 or so indictments have been announced since then, and I took a look closely at the cases. They've hardly found any spies at all. The largest number of cases, it's about 38% of the total, have been against professors, researchers, academics who do research in laboratories, who also, may teach a class in China or go give some lectures there. They've been charged with fraud for not disclosing, not checking off a box that they have done that, and yet the disclosure rules are very unclear as to who they were supposed to disclose that to and how. And so in the cases that have actually been charged, there have been virtually none of them has been charged with spying. There's only 20% of those cases that actually do allege any economic espionage whatsoever.
One of those professors is Franklin Tao, you profile in the piece. Explain why you chose his story and what he's been charged with.
So Franklin Tao was the very first professor to be indicted under the initiative. And he is charged with fraud for failing to tick off a box that says he had a conflict of interest. What he actually did do, according to his defense attorney, is that he was looking for a job in China, and he was emailing back and forth with a university. He's teaching at the University of Kansas, and he actually just was kind of, exploring, what would be the possibilities if I went back to China? Now, according to his defense, he never signed any contract. He never actually did teach in China, and he decided not to take the job. He just, resumed his teaching duties in Kansas. But when the FBI actually conducted a search of his emails, and that search, the defense attorneys tried to get ruled out because, in fact,
they've charged that the FBI actually engaged in misconduct in actually doing a search of his emails because he was accused. He got into a dispute with a co-author in a research paper and was accused by the co-author of not giving proper credit. And then the co-author said, "I'm going to report you as a spy to the FBI." She said that in an email that was revealed in the court cases. And so as a result of that, the FBI got a warrant, found that the professor had this correspondence with a university back in China, and now he's being charged with a felony fraud, which carries a sentence of 20 years in prison.
So you mentioned fraud there, and in general, almost none of these individuals have been accused of spying, but there have been cases of academic researchers and professors just failing to disclose their affiliations. So walk us through, how the Department of Justice has actually dealt with what they've actually found.
So the first case to go to trial of all of these cases against researchers, there were 6 cases dropped over the summertime. A number of the cases just simply haven't held up when they've gone to court. The very first one that did go to court in June, that was a professor at the University of Tennessee at Knoxville. He actually the first trial ended in a mistrial. The Department of Justice decided to rebring the case. And then the judge actually didn't even let that go to a jury. He just issued a directed verdict in September that basically said, look, this guy didn't do anything wrong. There's no evidence of fraud here. He was supposed to have disclosed if he made more than $10,000 in outside lecturing from universities in China, which he had done over a summer when he wasn't teaching. He actually earned only $3,000, and yet he was charged anyway. So that case actually the judge issued a rebuke essentially to the prosecutors and to the FBI that there wasn't enough evidence here to charge this person with fraud whatsoever. And virtually half of the cases that have been brought against these researchers have been dropped. So they're just really not standing up in court. We have the latest case actually to go to trial is that of Charles Lieber at Harvard University. His trial started yesterday, and that is going to be ongoing in the coming weeks. It's going to be very interesting to see what happens in that case. He's accused of lying to Harvard University about some teaching and research that he was doing at a university back in China.
So in terms of the initiatives or the stated goals of this strategy that was put into place by the Department of Justice and the FBI and the other federal agencies, I mean, is it staying true to its mission, or is it kind of getting away from it? Because you really get into, I think, really some smart things in your story, Sheridan, about, there's transfer of technology or technology transfer that I think, countries are concerned about. There's also scientific cooperation that is just a normal way of life, often between global researchers. So what are your thoughts on that, or what did you find?
So it's very interesting, what these professors and people in the academic world say is that there's, of course, the largest amount of cooperation in academia in the world is between U.S. and Chinese research, and we publish papers all the time, constantly. There's a stream and flow of ideas. This is pretty normal in the academic environment. What the government was trying to do.
Okay, guys, as I told you before, I'm going to hold this position until tomorrow. So for you guys, if you want to close position, it's just 3 minutes left. Please do so, please. You can close at the place an order to sell at 112.93. If broker allows you, if you have spread 3 pips, so broker probably will allow you to close position at 112.90 or 112.85. Otherwise, you can hold it like I do until tomorrow. Okay, have a nice evening.
To be determined, it had planned to return employees to offices by February 1. This is today's environment. You're listening to Bloomberg Business Week. Sound On, coming up next.